Let's get you updated on our grain trade. Man, we are already seeing some whipsaw action. And let's turn to our quotes provided by Bar Chart here. Remember, we had the corn on the May contract opening limit up this morning. Well, now we're back to trading, so things have eased back a little bit. But May is still at $6.77 per bushel. That's up 21.5 cents. July corn, no slouch. It had been limit up a little bit ago. Right now we're up 18 3/4. We're at 6.51 1/4. So it's come off of its earlier high by about 6 cents. December now up a dime at 5.60 3/4. On our quotes provided by Bar Chart, we have the soybeans on July now 5.5 cents higher is all. We're at 15.21 1/2, and that is 23 cents off of our earlier high from the early morning trade. How's that for a turnaround? November now 8 3/4 higher at 13.50 1/4. That's off its earlier high from last night by about 14 cents. So what's going on here? Let's take a look at the wheat market. Remember, wheat, after it opened up, it continued to gain momentum to the upside, and it was at a point where it was over 30 cents higher there for a while. Well, we have July wheat in Chicago now 16 3/4 higher at 7.29 after a high of 7.46. Now, Kansas City wheat had the same type of action. We had the July setting a high of 7.19 1/4, and now we're at 7.02 3/4. Still leapfrogging over that $7 mark, but we're now about 21.5 cents higher and going backwards. Now let's look at Minneapolis wheat. We have July now trading 13 1/4 higher at 7.38 3/4. So what is the deal here? Coming off of our highs in the early enthusiasm, we turn to Chris Swift of Swift Trading in Nashville. What's the deal, Chris? What do you see happening here? Are we having a flame out, or is it just pausing to catch its breath here and go again?
Well, I like the way being put on point right as the market's going back down again. Yeah. Honestly, Marlin, it looks like a combination of factors that we've got going on. When you look at the droughts going on, we saw on Thursday when they released the Palmer Drought Index how much more severe through the Dakotas it had gotten, and now reaching into Wisconsin and Minnesota. That, with our lower U.S. dollar all week last week, we had a resuming downtrend in the U.S. dollar, and there's just some grave needs out there by China particularly showing their hand, buying corn last week at the very end of the week and soybeans first thing this morning. So we believe that China is still the big needer of our U.S. grains.
How aggressive are you when you're talking with your clients and other interested parties around the country when it comes to pricing new crop corn, new crop soybeans, and we don't even have the majority of the crop in the ground yet, but how aggressive are you about rewarding the rally we have seen up to this point?
You know, we look at it, probably having 20 to 25% of your crop already marketed is a good way to start the month out, I think. After that, I'm not really sure because we're sitting at a severe discount of the December contract to the front end, as well as some people are telling me they still got a 20 to 25 under basis for their new crop corn. So it's not as advantageous as what we can see, later on in the future, but maybe look at storage abilities, taking advantage of some of the premiums in the back end for the May and July of 22 contracts.
And one thing I wanted to take a peek at, we noticed this last week. The Oats Market, which a lot of folks overlook, actually got over $4 last week. Got as high as 4.12 3/4 this morning, and now we're at 4.06 3/4. That's up 3.5 cents again on the oats, and that would be what your new crop July oats are priced at right now, over $4. We'll come back in a moment, and we'll take another look at our livestock trade. We'll see if it's perking up yet or not when we come back. Well, let's go back to Chris Swift of Swift Trading and talk about our livestock trade. Let's go right to the quotes. And on live cattle here today, we have the June contract flipping around after picking a high early this morning of 116.55. Now we're at 114.95, $1.60 off our earlier high this morning. We are down, well, it just changed, now down 80 cents from our close on Friday before the cattle on feed report came out. August down 45 cents right now. On the feeder cattle trade, well, we have quite a bit of pressure in the feeders all across the board, over $1 lower. We have the May contract $1.97 lower. We're at 135.70. We had been over $2 lower there for a little bit, but right now we're about $1.50 off of our earlier high of the day. So that's definitely the trend going on in the feeder cattle trade. We'll talk about the cattle and feed numbers here in just a minute. On the lean hog trade, lower on most contracts. Right now you have June down 95 cents at 104.77. That would be about $1.15 off of our earlier high of the day, so a turnaround there as well. And let's go back to Chris Swift. We had the cattle and feed numbers that came out Friday, and most folks thought that was a pretty friendly report with that placements number way under the trade expectations. And yet here we are with lower trade all across the livestock market this morning. Why?
It was pretty much neutral more than anything. The average trade dress was right at 2 million head, and it came out at 1.977 for the placement number. So it looks to me like the packers have ample enough inventory now to move all the way into the Labor Day weekend with the amount of supplies on hand. The feeder cattle market simply impacted by the corn. Something's got to give. The cattle feeder just can't simply continue to pay these egregious input costs and not have to have something suffer for it. So I think, unfortunately, the higher corn is impacting the feeders this morning.
I noticed on the June live cattle, it's actually, well, it broke through the 100-day moving average here about a week ago or 4 trading days ago, and it's approaching the 200-day moving average. Now, if you look at a feeder cattle chart, I was looking at this, and it actually blew out that 200-day moving average about a week ago, and, you know, that's technically not a very good sign there, Chris.
No, it's not. And we have ample inventory to work with. And, of course, people say that we've got, limited packing supplies, and no doubt that we do to an extent. However, the packer still isn't even killing up to those limited kill slots. So there is, in my opinion, ample packing capacity to be able to take some of this, but there's just not a need to. We've got so many cattle on hand, we're just not afforded any leverage right now.
Well, thanks for explaining that. I appreciate that. Chris Swift of Swift Trading with us from Nashville. Janet, back to you.